Welcome to Darren Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darren Batchelder.
Hello, everyone. Today we have a very special guest. We've got Michael Episcope with us. Michael, appreciate you coming on the show.
Thanks for having me, Darren.
Absolutely. So just a little bit on how we know each other. So this is actually the first time that Michael and I will get a chance to speak. Somebody reached out on Michael's behalf to see about getting on the show. And, just quite frankly, most times I don't do that unless I know the person or the person has been given to me as a referral. But I did review the background, and I was like floored at the scope of experience that these guys have. So I'm very interested to hear more, and I hope that you guys will learn a lot out of this. So with that, first question I typically ask is, how many properties and how many units are you guys currently invested in?
So we have roughly, it's constantly changing because we're both buying and selling in today's market, somewhere between 40 and 45 total properties. Generally, we're in the Sunbelt states south of the Sunbelt, and we're close to kind of 9,000 units, tracking towards 10,000 units. And those are both portfolio of properties that are stabilized in some stage of value add or being built under control, et cetera.
Yeah, this is amazing, guys. These guys have transacted over $2 billion, like $2.3 billion if I have it right, in total deals. And in terms of ranking, they are in the top 1% for North American real estate fund managers. So these guys have a ton of experience. How did you even get into the space? What were you doing before, and how did you even get into the space? And when?
I was a commodities trader. Yeah, it's a great question. It's sort of the why and how we began. But going back, this is my second career. I made my wealth here in Chicago. I was born and raised here, and I went down to the Chicago Mercantile Exchange at the young age of 19, and that was sort of the start of my first career. And to me today, I can't even believe it. I have a 19-year-old, and to think that he I was starting my first career at that age was kind of crazy to think about. But I sort of stumbled upon it, and I loved it. And I ended up, I was at DePaul University. I pushed all my classes to night. I burned the candle at both ends to make it work. I loved it. I was studying finance and econ, and also just seeing how the financial world worked by working there during the day. And ultimately, I ended up becoming a trader, trying my hand at that. I was pretty good at it. And for the next 9 years, again, I just worked bell to bell, saved as much as I could. And then my life changed on a few areas. Number one, when I started trading, I didn't have any money, right? And then when I was done, I had accumulated quite a bit of wealth. I was also, in the beginning, before I was trading, I was single. Then I was married, and then I had 2 kids and one on the way. And I was sort of like looking at it, and my risk profile had just changed. And so I kind of said, what's next? And I'm a little bit of a restless soul. I don't like to do anything for too long, and I needed a new challenge. And real estate was something that I was introduced to as a young kid. My grandfather was in real estate. I used to go help him in the summers. I kind of saw the way the income and just the wealth that it created for him, and I was always enamored by it. So I took that opportunity, punching out of the Chicago Mercantile Exchange, sort of moving into the next phase of my life, went back, got a master's of real estate at DePaul. And my partner and I were, we had already been working together on various things. We were friends. We really saw the world in a very similar light. He was doing some development projects out on the East Coast. We had gotten together and just decided that we wanted to build a firm together and manage our own money. So in the beginning, it was more like a family office. And then what happened was it just sort of evolved, and we brought in friends and families. We were finding interesting deals. And that was in 07, 08. So, in a lot of ways, it was a great time to be starting a firm. Now, if I knew what I knew today back then, would have fast tracked. But we've been in this for 14 years. And I would say we started hitting our stride about 3 or 4 years ago. But it was really like that notion of alignment, us investing in our deals, us sitting at the table as investment managers, hiring the team, looking at this from a different perspective. And I think in many ways, not being from the real estate or having that 20-year, pedigree and being, kind of saddled and thinking about how to grow a firm benefited us. And we really, we pride ourselves on thinking differently, doing things differently. And then it was just about building a firm for people like ourselves, for individuals, family offices, for the clients of wealth managers. And so, what really motivates me and gets me up, every day is helping people like me really grow, protect, generate passive income, in real estate and getting the benefits of passive real estate. It doesn't really interest me that much to be working for, a pension fund or an endowment or anything like that, because people like us, we work hard, we've saved our money. And historically, when you go back to 06, 07, 08, the market was very different and there weren't a lot of, great opportunities out there for individual investors. So we've always had this notion of we wanted to build an institutional real estate platform for the individual investor. And we made a lot of great decisions. And that's really like Fund 1, Fund 2, Fund 3, those ended up, top ranked funds. And then Preqin most recently, to your point, ranked us as a top decile manager, we say. We're actually in the top 2% of national rankings of more than 2,000 investment managers. So we're very, just proud of what we've done, our track record, our team, and just the way we do business. So it's something that we think about, not only the past, but how do we continue to deliver that same value today and in the future, especially as we scale and we grow.
That's a fantastic story. So, first of all, you partnered with somebody that you were friends with. Did you guys work in the commodity space together, or was it a college buddy, or how did you guys get acquainted?
No, actually we just met through mutual friends, and I'll never forget meeting him. We were just like kindred spirits, and we had a lot in common, and we didn't know each other in college. We had very similar backgrounds. He was in the commodity space. He left much earlier than I did. He left around 2000 to start a nonprofit, to do some development on that side. And I always say, like, there's two people in my life that I'm very fortunate to have met, my wife and my partner, and you don't find people who you cross paths with too often that you really are in sync with. So I'm very blessed to have him as his partner. He's incredibly smart, and it's been a great kind of 14 years together.
Yeah, that's fantastic. And you said two things. One, that you saw the world in a similar light, and you also said that you were kindred spirits. And I've had other syndicators on the the show that have talked about you have to have complementary skill sets and typically focus in different areas and grow with your partners, but you also have to have the same kind of ethical standards. You have to be aligned with that person, because you are going to be working with them for a long time, and if you look at the world differently, then you might have a lot of friction. So that's fantastic, and it's very consistent with what I've heard from others.
Yeah, and Darren, I'll say that it's so much more important for your core values to align than your skill set to be complementary to one another. Because if you don't view the world through the same lens, the integrity, the ethics, and I would say, it's not about approving deals or what he does. Skills can be learned,
sure,
right? And you can augment those and do different things. And certainly there have been some growing pains along the way, and some stepping on toes of each other. But the way we've managed the firm is that David really covers the real estate side of the business. He manages the investment management side, and then the acquisitions team. And I manage the investor relations side, the capital raising, the marketing, and then corporate services. And we come together on deal committee, both approving deals, because this is a lot of our own capital in these opportunities. And we also, we bring different perspectives to the table. So it's, having a partnership can be great when it works. And it can be, I know from others too, it can be really tough. So, but you got to get the core values right. And that's really where we see eye to eye on. And it's not like we don't, fight. We do, but we have a mutual respect for one another. When we disagree respectfully, and we walk out of the room, looking at each other's opinion and say, okay, I can see that, or I can see that. And then there's times, there are swords you want to die on. And I'll tell you, like when he comes to me and he wants to die on a sword, I'm like, okay, this obviously means a lot to him, right? I don't have a monopoly on the right answers, and I know that, and he knows that as well. So it's been a great push and pull over all these years.
That's great. And what's also different about you guys from a lot of the syndicators I've talked to is when you went to scale, it was kind of a natural order where a lot of the syndicators that I've talked to, they saw the opportunity to be able to buy bigger properties. They didn't have the capital to do so. So they went and started to syndicate and leverage other people's money so that they can buy bigger properties. But it sounds like, from your story, that the two of you guys came together, hey, let's just protect and grow our wealth. And then you had people naturally just saying, hey, what are you guys doing? Are you successful? Hey, can you do some of that for me? And then first it started with friends and family, and then you grew from there.
Yeah, and I'll say that when we went to outside capital, it wasn't about doing really bigger deals. I hear people say that, well, what do you want to do? I want to do really big deals. I mean, check your ego, right? It doesn't matter. I want to make money. I want to make money for me, our investors. I don't care if a deal's pretty or ugly or big or small. But it was really about looking at our business and saying, listen, if we want to really hire and attract a team, right? The team who we want to help find the best deals out there, manage the deals. There's a lot of infrastructure that's involved. And I think we learned early on that if we're going to do this, we really need to amortize all these costs over larger pools of capital, right? Because these are the people who we want to hire. And that's what it was about more than anything. And I would say in the beginning, because David and I had wealth, our investors were paying much better fees than we were. But we also knew that we were building balance sheet value and we were building a company. So I like to say, in Fund 1, David and I were paying 5% annual fees and everybody else was paying 1.5%, right? In Fund 2, because as we were getting, money, it was sort of like our investors were paying 1.5% and we were paying 4%, right? And but we knew that, there was no better place for us to be investing our money, and we were building a company out of this. And it takes a long time to scale in what I'll call the retail world, focusing on individual investors. And so few have been able to do that. And that's really why people start with high net worth. And then they, what I'll call graduate, or what they see in their world is graduating into the pension funds, because they want the 20, 30, 40, $50 million checks. And you can count on, one hand, the number of groups who have really successfully scaled with the individual investor only.
And that's what you guys focus on, individual investors only?
Yeah, that's it, the taxable investor. And it's really, I did a webinar last week and I was talking about the tax efficiency of real estate investment. And it's nice to have a homogenous group of taxable investors, right? So whether you're talking about a high net worth, ultra high net worth, the client of the RIA, family offices, et cetera, we're all in the same bucket. Now, when we think about how we structure funds, how we manage real estate, how we our just strategy, buy, fix, sell was our old strategy. Now it's more buy, fix, hold, looking at those tax advantages. Well, if we had a hybrid structure and we had pension funds who were also in the mix, and we had endowments and we had non-taxable investors, well, they really shape your strategy much differently. And we've partnered with them in the past. They don't care about taxes, right? But I do, and all of our other investors do as well. And it sort of creates this friction between the two groups. And ultimately, the the entity or the individual who comes with the $30 million check is going to make the rules, right? And everybody else is going to have to follow along.
Sure.
So I love the fact that we are focused, our group is homogenous, and we're helping people like us.
Yeah, that's huge. So talk a little bit about, I think you have 3 or 4 different funds. So talk about the different funds, talk about what type of assets you put into each of the funds, what's the pros and cons of one over the other. And, I know this is going to get long, but, a lot of syndicators are not set up to do funds. They are transactional. Yeah. They get a deal under contract. They raise the capital for that deal, and then they're on to the next one, and they do everything the same thing. So it seems like, okay, you started the company in 2007, maybe like 2011, 12, when you started doing funds. Is that
2011 was our first fund? Okay. Yeah. And Darren, I'll be, a lot of individual investors, they like deals, and we do both, right? We do deals and we do funds.
You do both. Okay, I didn't realize.
Well, yeah, we do co-investments on sidecars, right? And I'll get into that in a second. But when we started the fund business, it wasn't necessarily saying that, hey, this is better for us, we want to do funds. And I think a lot of people have this misconception that funds are better for the manager. What it gives us, and the advantage it gives us, is permanent capital, right? The ability to tap in and go to the table when we're competing to a deal and say, yes, we can close, we have the money, not, hey, hold on, we can close, but we got to cobble it together, right? Or we have a track record of that. So there's actually an advantage to individual investors when it comes to investing in the fund, because all of the promotes, right, the performance fees in a fund, if we have 20 deals in there, all those performance fees are cross-collateralized. So if 10 deals do well and 10 deals don't do well and we return a nominal return, we don't get paid a performance fee. If you look at those 20 deals and you're building a portfolio through syndications, if 10 of the deals do well and 10 don't do well, well, guess what? You're paying performance fees on those 10 deals that do well. So there's an inherent distinct advantage of investing through a fund. And what we've always said is that we create products that we want to invest in, and then we do, right? Our money is side by side with investors. But I'll get back to your question. We have 4 funds, and it really runs the gamut from lower risk to higher risk, yield to growth. And when we think about, like our strategy, it's only multifamily. We build, buy, and lend. We've done many other categories in the past, but really it's about specialization. Multifamily happens to be one of the lower risk asset classes out there. We are in Sunbelt states and South, so we're in the Southeast, the Texas markets, Nashville, and the Southwest, so cover quite a bit of territory. We have 35 people at Origin. In that strategy, when we think about build, buy, and lend, we also think about the consumer, right? What do they want out of this? Well, you have on one end of the spectrum, you have people who only want yield, right? They want income, they want that passive, tax-efficient income from real estate. And then on the other side, you have people who just want growth, right? They want to grow their capital. They don't care about income. Everybody has a different perspective. And then you have the middle, who want a little bit of growth in income or optionality. They want lower volatility. And so that's how we think about it. So our strategy, even though it's a 3-tiered strategy of build, buy, and lend, right? Then what happens with those is we put them into different funds and produce a benefit to the investor. So I'll take you through the real estate funds because the credit fund is a little bit different.
Sure.
But when we think about, our 2 real estate funds, there's a third out there. I'll get into that as well. But we have the Income Plus Fund. And the Income Plus Fund is a multi-strategy fund that has those 3 strategies in it. 20% of that fund is dedicated towards ground-up development. The other 80% is to lending and sort of core plus. It provides tax efficiency through depreciation. It provides stability through the lending portion of it as well, and also yield. So that's about a 9 to 11% total return is what we're trying to generate. 6% yield, but with very minimal volatility, right? And the mixing, generally when you have something like preferred equity by itself, that's not a tax-efficient investment. But when you pair it with common equity real estate that produces depreciation, that depreciation actually offsets, right? The excess depreciation offsets the tax inefficiency, so then you can produce a very tax-efficient yield in that fund with lower volatility. And the ground up development, there's a couple things. Number one, it generates alpha because that's the portion of the portfolio. But when we're looking at today's market, we're not really doing anything in the middle, which is buying real estate. There's always exceptions to the rule, but in today's market, where we're looking at projects that are 10 to 15 years old that are trading, 10, 15, 20% above replacement cost, we would much rather be building in those markets at a lower basis today, right? We think that's a better risk-adjusted return. So in a lot of these markets, like when we're looking at Phoenix, when we're looking at Nashville, when we're looking at Austin, you can't compete when you're looking at core plus and value add deals because there's a wall of capital. So we're actually out of that market. We're net sellers to those individuals. We're selling everything in Fund 3, everything in Fund 2, and we're just looking to enter into those markets by building. Okay, so that's our first fund. That's Income Plus, and then on the other spectrum is growth, and the growth fund that we're coming out with is going to launch on January 15th of 2022. That is going to be about 10 to 12 ground up developments that will be paired also with some GP elements, right? So a general partner investment means that you give above market economics, but what it does for us is it also gives us a pipeline into future deals. So working with sponsors over and over and over and providing that that development capital early on in the phase gives us a first look at all those opportunities. So it's I was talking about tax efficiency. Now, the interesting thing about this fund is it's very short dated. It's a 5-year fund, but if investors want to stay in, they can. So it's what we call a build to core. You're taking that development risk, and then you can stay in year after year after year, and you just let us know when you get out. And it's a mark-to-market fund because over the last 10 years, one thing we've learned is that in order to grow wealth, you need to buy great properties and hold them for a long period of time and generate, take advantage of the depreciation, the ability to refinance tax-free over and over and let the upside run. And we have deals that we've sold 2, 3, 4 years ago that are coming back to us now that are 40, 50% higher. And when you look at the most sophisticated investors out there, well, this is how they invest. And this is what we want to bring to the market as well. And more often than not, every time we sell a deal, we get comments from investors, hey, this is fantastic. What do I do with my money now?
Right.
Where's the next investment? Where do I go? Right, cool. Why did we sell this, right? Why couldn't we just get this 8 or 9% yield? And so that's a page that we've taken out of the book. So rather than being on this hamster wheel of, buy, fix, and sell, pay your taxes, let your money sit around, take a lot of risk in another deal, you can actually make a lot more wealth in this strategy just buying and holding forever. And that's true in real estate. It's true in stocks. It's true, across really every asset class. That's how real wealth. And you always meet these people who've owned a piece of property for 30, 40 years. Their basis is $300,000 and now it's $8 million, So we just don't want to keep making, those same mistakes. And that's why we've really changed our strategy from buy, fix, sell to buy, fix, hold going forward. So those are our sort of what I'll call our 2 flagship funds. We also have a qualified opportunity zone fund. That is we just came out with that, our second fund last week. The first fund was about $275 million, very tax advantaged. We could take up this whole time talking about that. And then the lowest risk spectrum fund we have is called our Multifamily Credit Fund. And that is only for qualified investors, or qualified purchasers. It's those people who have more than $5 million in investable assets. And candidly, it doesn't, even though the fund is secured by loans of multifamily real estate, it qualifies more as a security than real estate. So when you think about asset allocation, you've got real estate and you've got credit, and the multifamily credit fund falls in the credit bucket, but it uses real estate to generate the yield in that fund.
Gotcha. Hey, I don't know if we'll spend the whole time on it or not, but I haven't really had many people on here talking about opportunity zones. So I think that if you could spend some time sharing, what qualifies, for a deal in an opportunity zone. What are the benefits? What are the downside of doing that sort of thing?
Yeah, I'll try to give you the abbreviated, maybe 5 to 7 minute version here, because we've literally had webinars that have gone hours on this. So, Qualified Opportunity Zone came out of the 2017 Tax Cuts, and Jobs Act. And what it is it was a bipartisan measure to, the purpose was to take, sorry, I just had a little glitch there on my camera. But to get money out of the hands of the wealthy, right? Incentivize the wealthy to actually invest in neighborhoods, moderate to low income neighborhoods, right? And how did they do that? Well, they created this plan where they mapped out 8,700 qualified opportunity zones that are based on the 2010 census, right? And when this came out, there was a lot of skepticism about it. Number one, what do these neighborhoods look like? Are they investable? Because what happens is if a wealthy investor has capital gains from any source, it can be from real estate, it can be from stocks, it can be from bonds, whatever shows up on your K1, if you invest that capital within 180 days into a qualified opportunity zone fund or property, you get 3 tax benefits. The first one is called is really a reduction, or it's called a step up in basis. So I'll use very round numbers here. If you have $1 million in capital gains in 2021 and you invest in a qualified opportunity zone fund, that will be reduced when it comes time to pay taxes to $900,000. So there's a step up in basis. That's the first. Now that only lasts through the end of this year, and then that disappears. So it's only if you invest in 2021.
2021. Okay. The other thing I wanted to ask
for the step up in basis.
I wanted to ask on that was, a lot of people, I'm sure you're aware, have been taking advantage of bonus depreciation. But then when you sell, you've got the recapture. Could you end up selling a property in 2021, have the recapture, and then do an opportunity fund so that you don't have to pay back that recapture, or it would?
That is a really good question. So I don't know exactly about that particular nuance itself, right? So I think you're talking about somebody coming into a qualified opportunity zone fund if they have to pay the excess depreciation, right? The recap. So the general recapture is no, right? Just like you wouldn't have to pay it, I think, if you went into a 1031 exchange. But I'm not sure about the excess depreciation on that. But there's 2 more benefits, and I'll get to. You don't have to recognize the taxable gain until 2026. So this is like an interest-free loan for the next 5 or 6 years, and that is only payable in 2027. Now, the risk is that if you're paying at today's tax rates and you have a capital gain, you're going to be paying right around 24%, 20% plus the net investment income tax. If in 2026 the tax rates on capital gains are 30%, you'll be paying 30%, right? So that is the risk, but it's somewhat offset by the step up in basis. But all that aside, the best benefit of this program is the fact that if you are invested for more than 10 years in a day, there is no tax on your gain. So if that $1 million grows to $2 million, $3 million, $4 million, and you take it out at 10 years and 6 months, right? You pay 0 taxes. So there is really, like, Darren, when I talk to people about this, I'm like, look, if you like real estate and you have capital gains, there is no better place to invest than QOZ right now, because the after-tax wealth that you create through a QOZ fund versus the math on using after-tax capital to invest the same way is about 75% greater. It's not even close, wow. Right? So it's an amazing gift to investors. And I think some of the misconceptions are from what I said earlier. Well, I don't want to invest in these, low income, moderate income neighborhoods, right? Well, neither do we. You can't make money in those, right? And we don't look at QOZ any differently than we do our other funds, our investing strategy. And the way we got into this, back in 2018 was doing a lot of research and looking at the markets and kind of where the QOZ areas are, because we approach everything skeptical as well. And our job is to sort of look for the icebergs and the holes and, where are we going to lose money? And what we found is that a lot of the deals that we were already looking at in Fund 3 and actually owned were in qualified opportunity zone areas. These were transitioning neighborhoods. And when you think about how much cities have changed between 2010 and today, it's mind-boggling, right? It's staggering. If you went to Denver, if you went to Nashville, if you went to Austin, any of these cities 10 years ago, and those census tracts were based on the city back then. So I'll give you an example. Like in Nashville, we have one of the best development sites right now tied up. Not QOZ development sites, but best development sites in the country tied up. It just so happens that it's in a QOZ area. We're working through entitlements. We've gotten, we're working with the city right now to get this through zoning. But it's a phenomenal project. And we don't, historically, when we're looking at qualified opportunity zone projects, we're not competing against QOZ funds. We're competing against the pension funds and the endowments out there in institutional capital. They don't care about the qualified opportunity zone benefits. It's just good real estate. So I would, candidly say that 95% of the qualified opportunity zone areas, you can't make money in. They're not worth investing. And so we're really fishing around the edges, looking at those 5%. But because we've been in this for 3 years now,
sure.
Our pipeline is incredibly deep.
That's huge. Now, is there some education component to the individual investors that, some people get, even though you talk about the real wealth is, buy and hold forever. There's a lot of investors that still like that, man, I doubled my money in 3 years, and so, some of those people, is there an education component to them to get them to say, hey, take a piece and lock it down for 10 or more years?
Yeah, there is to a degree. I mean, you have people who have all kinds of different time horizons. And I've had, one of, an investor said to me, Michael, I'm not even buying green bananas right now, so I'm not even looking at this. So, but yeah, there is. And what I always tell people is, look, you might be wrong over the next 2 or 3 years, but what you will be right is over the next 10 years. In multifamily real estate, institutional quality real estate, the stuff we're doing, $40, $50, $70 million projects, has never lost money over any 10-year period. So for me, I love the fact that we don't have to, constantly talk about the timing of the sale, this or that, because even if we go back to the worst period, right, in 07, if you would have bought at the high in 07, right, 5 years later, right, so let's say the QOZ opportunity zone came in 07, and you were like panicking and you wanted to get out in 9, 10, or 11 or something like that, but you couldn't, and you were locked in and you stayed in until 17, you would have made phenomenal money. And I think in the depth, right, the fact that we couldn't sell, we weren't allowed to sell, we would trigger this massive capital. We can't as a fund manager anyway, because it would violate compliance. But when you hold long enough, what you can be sure about is that replacement cost is going to go up, that rents are going to go up, that the property will be worth more in 10 years than it is today. I don't know if that's true in the next year, 2 years, 3 years, right? And so you have to have a long-term outlook when you're investing in this whole short-term, hey, I want to be in for 3 years, I want to sell, I want to pay taxes, I want to do this. That's not how you're going to get wealthy. Too many people chase IRR, but you can't eat IRR. You can eat multiple.
Yeah, that's great. The other thing I would think, and I'm just thinking out loud, because I've been in the loan. I also have a loan trading business, and I've been in that space since like 2002, single family, multifamily, and commercial real estate loans. And in the last recession, where I saw people get hurt is maturity risk. So like you said, over 10 years, you're going to be fine. But if all of a sudden you go into a recession and your loan comes due in a terrible economy, cap rates are up, cash flows down, all of a sudden your valuation is negatively impacted. The lender tells you they're not going to refi the loan unless you bring additional capital, and you can't raise capital in that type of market.
Right.
So with an opportunity zone deal, I would think that it makes the financing decision easier. That, hey, look, we're gonna get 10-year fixed rate loan. Is that the case or no?
That we do longer term. So you certainly can't get that on the construction side. But when we think about risk management, and that's something we're very good at, is thinking ahead and stress testing deals. Well, the first thing we do, which I think is really important, is we're putting in 35% of equity into these deals, right, on the ground up construction side on a cost basis. So and if you believe, right, the pro forma, we're building to anywhere between a 30 and 40% margin. So when you think about the amount of equity that we have in from day one, round numbers, I'll do 100 million because it's easier for me to do the math. We're putting in $35 million. And if we do our job,
you're saying the company.
The company, all the investors combined. So okay. Origin, right. So if we do our job and it's $100 million of cost and we're building to a 35% margin, that means when we're done, the property is going to be worth $135 million, right? Well, our debt is only $65 million. So the loan to value, once we're finished, is incredibly low. And generally what we do is we will then resize the loan at 65% of value. And having a lot of equity in the property is the first way that you mitigate downside risk, and to your point, fixed rate debt as well, right, with longer term maturities, not, and having things staggered. So when you have when you can't sell an asset for 10 years, there's no reason to put floating rate, debt on it for 3 years at a time, right? There could be a certain portion of the portfolio that we do float, right? Because historically fixed rate debt has been far more expensive than floating rate debt. And you can go through history and look at this, right? So, there's reasons to do this, but generally the portfolio has fixed assets and it'll have fixed debt.
Yeah. I mean, there's, like you said, there's lots of reasons. If you're doing a 3-year turn or 4-year turn or 5-year turn, look, people that put long-term debt on 2 years ago, they could sell the property for a pretty penny right now, but they have to pay huge prepayment penalties. So they're stuck, they can't.
Well, listen, we're dealing with a lot of that right now, where some of our defeasance on our properties, and that's what we would have to pay the lender, is, $3, $4, $5 million. Now, we've also bought properties because they have this long-term debt on them, and then people change their mind. And, to us, it's all about the basis. Loans can be refinanced, but you can only buy a property, one time at the right basis. So we have some properties that, we bought at really a great price, because debt, what happens when you have above market debt, it actually detracts from the value of the property, right? So then it becomes lower. So it doesn't give you the optionality and flexibility, but QOZ, candidly, we don't need that, because we're bound by the law and we can't change our mind in 3 or 4 years and sell a property, because it would violate the covenants of the law.
So if I'm hearing you right, the home run is to go in the opportunity zone. Is that what I'm hearing?
Yeah, I hate the word home run because I don't think about investing as home runs. I think about it as singles and doubles, and maybe you hit a home run within the portfolio every now and then, So for us, we're trying to double our money at the property level every 5 years. And if we're wrong, we want to be at a 1.6, right? And if we're right, we want to be at a 3 or 4x, over that time period. And so, it's just about being consistent. But certainly, I would say the smarter investment move, if you like real estate, you don't mind being in ground up development, you have a longer term outlook, QOZ is definitely the way to go. And keep in mind, Darren, that after about 3 or 4 years of QOZ, what you're doing is you're building a Class A portfolio that will ultimately cash flow as well. So you get the benefits of the depreciation, you get the benefits of the tax-free refinancing, the cash flow, everything in that. And it's very much like our Growth Fund 4 that's coming out in January, except Growth Fund 4 doesn't have the QOZ benefits, right?
So is the return profile similar between the growth and the opportunities?
Yes, it is.
It's similar.
Well, it's different, because if you think about the growth fund that's coming out is going to be very short, and it's going to be over a 5-year period and possibly even shorter, because in that particular fund, depending on how quickly we can raise the capital, we will have a 2-year investment period, and I think we'll be done a lot faster than that based on our pipeline, and then a 2-year stabilization period. So, it was important to us as we were concepting this fund, right? Like there's a couple things that are bad about funds, and I've been in these, so I know. One is the fund tail. And you can have these funds that are 7-year funds, and then they have a +1, +1, +1, +1. Well, I have funds that I got into in 2007 that are still using this +1, and you're like, this is a pain in the butt. So, you end up with these tails, right? The greatest thing about this is that this is going to be NAV based, right, on appraisal. And if somebody wants to punch out, in year 5, they're getting out 100%. They're not going to have these fun tails where we sell all these individual properties. But what we do as a manager is we just make sure that 6 months prior to the fund's expiration, we understand how many people want to redeem, and then we will sell enough properties to redeem them and maybe a little bit more to have a little bit of a cash cushion. But that's how we would manage it. And so if we have 12 properties in there and we have to sell 3 to redeem these commitments, we will. But really that 5 years is what, you start to see the multiple build, and you also see the IRR start to maximize in that, right? And then over time, as you hold longer, you're going to be maximizing the multiple, but sacrificing IRR because those move in different directions.
Gotcha. So all of these funds are geared towards accredited investors. Is that correct?
Accredited, and the minimums are anywhere between $50,000 and $100,000. Okay. Except for the multifamily credit fund, which I said is only for qualified purchasers, those who have $5 million of investable assets or more.
So the what about the opportunity zone? Is the minimum 50 or 100 on that one?
50, yeah, and that's for accredited. Yep.
Well, we will have to talk offline on that one because I am not invested in. I'm invested in a lot of multifamily deals, but no opportunity zone deals. So we will talk about that. So help me understand. One of the things that's a little confusing with a fund structure is, okay, you're buying multiple assets, and if you're an investor, or say I'm the investor and I'm going to invest in the growth fund and you're going to buy 10 different assets. Well, if I invest my money right when you open the fund, that is more risky because you don't have any cash flow yet. And then somebody else invests after 2 deals are, purchased, and maybe I think yours are ground up development, but let's just assume that somebody buys into it after there is positive cash flow. Well, they have less risk. Are they coming in at a different price point than me if I got in originally?
Yeah, great question. So I should caveat that there's some nuances about these funds. So the Income Plus Fund is actually an open-ended fund where you do invest all of your money on day one, and you are diversified across a pool of assets. Growth Fund 4 that we're coming out is a called capital fund. So everybody commits capital in a called capital fund, but we don't call your capital until we actually find a deal. And if you think about it very simply, right, if we have 100 investors in that fund and everybody contributes $1 million, everybody will be a pro rata owner of 1% of the fund. And so if we find a deal for $10 million, we call $100,000 from everybody, right? And so everybody has an interest in that fund. But you are right in thinking about it, because in closed-end funds, you have multiple closings. You might have one every 3 months. So what happens in those later closings is that the later investors have to really pay earlier investors a preferred return. They also have to true up their management fees and other things. So it's as if everybody came in on day one. Some people like to be in on that first day because they like to start earning their pref and putting money out. And some people, candidly, they like to wait. They're like, look, I want to see how the portfolio is shaping up. I want to get, kind of a look. I want to see the first 3 or 4 deals. And I'm okay with paying, those few percentage points back to the earlier investors to get that look. So it all depends, and in a fund like this, I think we'll be out to market for about 6 months. So there's not going to be a huge difference in terms of the preferred return and the management fees that are going to have to be trued up from the investors who come in at the end or the beginning.
All right. So let me ask a follow-on question with that. So, I mean, your example was 100 investors at $1 million a pop, and first deal, maybe they get a pro rata call of $100 grand each. What if somebody just wanted to invest $100 grand? They didn't want to invest $1 million. So then they just have a $10,000 call? Is that how it works?
That's right. Okay. Exactly. Yeah. Their pro rata ownership would be much lower. It'd be 0.1% versus 1%. Gotcha. Yeah. So investors can come in. I mean, we have investors who come in at the minimum, for these funds at $50,000, and we have investors who come in at $10, $15 million for these funds. Right. So it just depends. Obviously, you're you're going to be more exposed to the individual deals the more you come in to these deals. So, if you do invest $1 million, go ahead.
Another question on the call feature. Is there a penalty, or if you go out for the call and somebody says, you know what, I changed my mind, or I don't have the money, or I lost money, and I was gonna sell stock and I lost money and I can't do it now. Do they have any kind of financial downside for that early commitment?
They do.
Okay.
Yeah, absolutely, Darren. Because, as a fund manager, we need to make sure that when people make commitments to us, that we're able to run the fund, that we have the money, we have the strategy. People aren't trying to time. Things happen. That's our job out there.
Sure.
But candidly, like if somebody commits and we haven't called capital, there's no teeth in the deal. But if we've already called 50% of somebody's capital and they can no longer fund, then there would be penalties. Now, I'll say, when we think about the world and the way we operate, there's what's in the PPM and then there's life, right? And so everybody has a different story. And if something happens to somebody, in the past, this has happened to us, we bought them out, right? We've allowed somebody, because there's always people who want to get in later, take over those positions, do something. So it's an investor by investor choice. But if, there's always exceptions to the rule.
Yeah. So the agreement is that, hey, they've got a penalty, and then, life is life, and you may, waive that, depending on circumstances.
Exactly.
So, hey, talk about, I don't think we've talked about it yet. You guys have done a lot of transactions. What's been the performance on the portfolio? Like, what are the returns typically?
So on realized deals, that's a good question. I know those are constantly moving. I want to say from an IRR standpoint, and this is underneath the fund, because I can go back. Our fund realized returns, if I go back to Fund 1, that was a 2.1 multiple, a 23% IRR. Fund 2 was around a 2.0 multiple and a 21% IRR. Fund 3, we're actually selling that right now. That was a 2016-17 vintage. That multiple will shape up to be about a 1.6 to 1.7, and right around a 12 to 13% IRR in that particular fund. And then in the Income Plus fund, we've had a great year. That's actually a 17. Now, granted, Income Plus is supposed to be, sort of a 9 to 11% annualized return, and over the last 12 months, that fund has been 17% IRR over that fund. And then the QOZ, it's too early in that fund. Like those deals, we have 2 deals that are up and going right now, and then the rest are in construction. And then Growth Fund 4 is coming down the pipeline. Growth Fund 4, we're targeting 14 to 16% net IRR, and then a 1.6 to 1.7 multiple on that fund. And candidly, like when you look at the world, we always tell people, don't expect the same returns you've gotten for the last 5 to 7 years. We believe that there's still good returns to be had, but all of our returns, and I should say this, on our realized deals, like we've generated over a 2 multiple. We've generated, high 20s returns on the individual deals, but never in our history have we ever gone out to market and said, hey, we want to generate a 3 multiple on a deal or a 4 multiple on a deal. Like everything is very consistent, and that's also what I find interesting about this market too, because what things look like on Excel and even in your gut, and you look at them and you're handicapping these deals and you're underwriting them and you're sort of massaging 100 different variables. But you might look at a deal, and there's plenty out there. Like we've had deals, our worst performing deal was a 105 multiple, right? And I should also say we've never lost money on any deal in a fund, so that was one of our deals. But we underwrote that to a 2x return, right? Well, life happens. It didn't happen, right? And, on the other hand, right, same vintage, very similar process. We underwrote another deal in the West Loop of Chicago that ended up, like 2x return on paper. It ended up being a 4x, right? So, Excel, like this is the advantage of being in funds, being spread across multiple deals. We don't even know, being close to the business. But, you want when you miss and and you're wrong, you want to be wrong to the right side, right?
Sure.
Not to the downside, but to the upside.
Absolutely.
And that's why we've always underwritten conservatively, looking at these these opportunities. So that's a long, kind of winded way of answering your question about track record.
Absolutely. Talk about when you started the company. It was you and your partner, and you were already wealthy. I mean, you already made a lot of money in the commodity space. How has the real estate space been in terms of wealth generation compared to what you earned in the commodity space?
It's apples to oranges, and I'll say this, that this next phase of my life was not about, creating wealth. That's what the first phase of my life was about. This is really about keeping what I've built, right? And continuing to grow it and continuing, to have passive income. And what David and I have built is, really proud of Origin Investments. But that's, most people, like when you think about real estate in a portfolio, sure, you can get wealthy. And, a lot of sponsors do, using high leverage, leveraging their money, other people's money, et cetera. But that's not really what this was about for us. So I think real estate is one of the best tools that you could possibly use, in lieu of stocks and bonds, to grow your wealth, to generate passive income, cash flow, et cetera. And Darren, what I find interesting is we've studied a lot, not only the private real estate, but also the public real estate side. And real estate has outperformed stocks over the last 20, 30, 40 years, and certainly has outperformed bonds as well. And the interesting thing about it is it's a hybrid between bonds and equities, because you have fixed leases that make it act more like bonds and give it stability. But then you have replacement costs that continues to increase. You have lease escalations that helps increase as well. And so, when you think about efficient markets, really your equities should be the ones that are outperforming because of the risk you're taking in the common. And then you've got the real estate asset that should end up somewhere between stocks and bonds, but it hasn't. It's actually outperformed. And I know, I've read your website, and it's been a huge wealth builder for so many families. And I just think that, as we were studying this, too many people are under allocated to real estate in their portfolios, and even, wealth managers, sometimes when you talk about public REITs, they see those as alternatives. But when you start to look at the data and the information and how they have performed relative to the rest of the public equities, it's not even close.
Yeah.
Like, really, it should be about, you should have a portfolio of real estate with 5% being in other stocks, and you would have outperformed everything on a risk-adjusted and an absolute basis over the last 20, 30, 40 years.
Yeah, it's crazy. And there's a lot of people that don't know how to do it and haven't developed a relationship with somebody like Origin Investments or another syndicator. And so, and they don't want to spend the time to go out and do it. So, themselves, it's a shame because, stocks just don't have the tax benefits and don't have the leverage that you have in real estate. And, you also talked about, the leases, and my son's a junior at college at A&M, and I was at a parents' weekend and met a gentleman that, he's done very, very well in the industrial space, and the company he works for, and industrial properties have been on fire, right? I mean, they've done very, very, very well. But he was like, you're in a better spot because, we have locked in, 5 years, 10 years worth of rent bumps. But, with multifamily, they're typically annual leases. So
yeah, and a lot of turnover. Yeah.
If all of a sudden there is rampant inflation, you can adjust the lease, accordingly, or based on supply and demand, whatever. But with those other properties, they're not able to because the rent bumps are locked into the contract.
Yeah, I agree. I think office is in real trouble for that reason, but also just because of what's going on in the demographic changes, the work at home environment. So right now, I always am concerned though, because when I think office is the new retail in certain areas. Retail has just been getting pummeled for the last 20 years. It just continues to be on the ropes. And, all the money, though, is flowing into multifamily and industrial right now. And there's a lot, and some self-storage and things like that. But those are really the areas where the fundamentals favor those for the next kind of 4, 5, 10 years. Right. So we're keeping an eye out, because you have to be careful when all the money flows into right. one sector right. as well. So it's kind of like, hey, we're here first, but candidly, when we see what's going on the for sale side, the existing product, and it's trading so far above replacement cost, guess what? It's a great time to sell, right? And if they're right, then our build strategy is only going to be better. But one of the reasons, I just had a little something happen there.
No worries.
But one of the reasons, if they are right, then, we're going to do fine. So you have to just manage your risk at every point in the cycle, but no tree grows to the sky. And that's the power of diversification and being in good quality real estate as well.
Absolutely. So you guys have shifted from, buy, fix, and sell to buy, fix, and hold, and you're focused more on new development versus buying existing properties. I've seen a lot of syndicators that have kind of, in the last year and a half, 2 years, that have been focused on trading up, and some of them are just moving from like C class assets to B plus and A assets. Some are getting into new development. On the new development side, how do you manage inflation of raw materials to build? So do you adjust rents accordingly? If all of a sudden, like last year, lumber costs went crazy. It's come back down, but, if you have a run in commodities prices where, it wasn't in your budget, are you readjusting the leases when you come up to lease up?
Well, you have revenues and expenses, right, that you have to factor in. And so in a development pro forma, you're going to know what your costs are going in. And we generally get a guaranteed max contract, right, a GMP. And that contract, you're starting on day one. You know what all the line items cost, right? And then the builder is locking those in with the subs, et cetera. So if you want to, now interestingly enough, we had a deal where when lumber went to $1,600, the deal still worked. But we said, look, we're going to underwrite this at $1,600, but we want to leave these line items out. And we left lumber out, but we're able to price it at that $1,600, $1,700. Now, we're not trying to trade, but you look at it and you're like, this can't sustain, right? Or else the world is stopping because you just can't make, new housing work at $1,600 per board foot of lumber. And what happened is then lumber came all the way back down to $450, $500. We saved millions of dollars on the project for doing that. So, those are but today where lumber is, I think it's, $700. We're not going to do that, right? Because the risk reward is not the same. It could go back up to $1,600, right. But what are we going to save? A couple $100 if it goes back down. But those are some of the ways we get, kind of creative. Everybody's really concerned about costs, and rightfully so. And what I tell people is that, look, the cost you'll pay today to build multifamily is more expensive than the cost a year ago. That's true. And the cost a year ago, guess what, was more expensive than the cost the year before. And I could keep going with that in year. And that's just the fact in multifamily and generally real estate, is that every year you go out, you're going to have inflation in materials. Do you have, these recessionary periods where people are slow and it comes down and you might save 10% and it resets? Sure, right? The offset to that, though, is you have to look at the revenue as well. And when you have revenue is the equalizer, because that's the multiplier effect. Because when you look at cap rates, right, a 4 cap rate is the same as saying you have a 25 multiplier on your earnings, right? So there's a lot of leverage on that side. So you don't need much, right? When you have a 20% increase in cost, you only need a corresponding $75 per month increase in rental rates, per month in some of these properties, right? When you don't quote me, it's not exact, sure, but it's pretty close. And when we do the math, you look at it, and I'll tell you, when you have places like Phoenix that are growing, 17% year over year, right, from the depth, and those rents are growing at $250, $300. Well, the way the calculus works out is that your development margins, even though you've had costs that have run up, they're actually getting bigger than they were in 2018 and 2019 because your revenues are just soaring far ahead of costs.
Right.
So hopefully I made sense there,
Yeah.
but that's kind of, there's two sides of that equation, and everybody is focused on cost. But you can go back into the history of real estate, and every year you're going to have higher costs. I think what really exacerbates this is just the magnitude of those costs in the last year. But keep in mind that we're coming off a very low. And I think what we have to really concern ourselves now is these supply logistics. And even though we're entering into these GMPs, can people get the cabinets, the studs, the drywall, everything else, on time into the property so we can lease it on time as well.
Absolutely. So you guys have done so much. What's the next big stretch goal for you?
Stretch goal. That's a good question. We think about, we're actually having a meeting with our team leaders in about a week from now, where they're going to, present kind of the plan for their individual divisions. They all do a SWOT analysis on origin. So, when we think about, we want to continue to grow and deliver the same quality that we have for the last 10 years. And that's hard to do, especially as you scale. When you go from managing $300 or $400 million of equity, and then you go to $1 billion, and then you go to $2 billion, how do you build the engine to be able to deliver the same quality? And I mean, in the investor relations department, that's still that high touch, right?
Sure.
The returns on the ground, everything. So we're expanding, but one thing David and I have always done well is we've grown at a measured pace, and we're not afraid to say no, to turn capital down, to turn deals down, to do things, that make sense in the long run. Because I think one of the roles of a CEO is that you not only have to understand like where you're going in the next 12 to 18 months, but really be looking out at the horizon 5 years out. And so, our stretch goal, candidly, like when we look at, we're going to be at 10,000 units, probably this time next year. That's not even a stretch goal. We have about 2,000 investment partners today who we proudly serve. And that was a stretch goal. When we look back 5 years ago, and we had 100 investment partners, and we've grown the business from, I would say that goes back about 6 years ago, from 100 investors to 2,000. That's been huge. So, we'd love to get up to 10,000 investors at some point in time, in the future. But it's, Darren, it's doing more of the same and making sure that we're delivering the same quality to the market.
Fantastic. What do you like to do outside of work?
Good question. Well, today it's pretty miserable, so I'm not doing anything today. I think I'm in Chicago right now, and it's been pouring. But
so golf.
I have 3 boys.
Okay. Family.
Yeah, well, I do. I golf. Yeah, I golf. I have 3 boys. I've been married for 21 years. My boys are 19, 17, and 14, soon to be 15 in another couple weeks. So they keep me busy, very busy. I love to snowboard. Big snowboarder.
Oh, yeah.
I tend to go out.
Where do you go?
Out west.
Cool.
God, everywhere. I go to, you name it, I've been there. But Whitefish is kind of a new place for us to be going. That's great. That's kind of the untapped resort in Northwest Montana. I go to Big Sky, Telluride.
Awesome.
Breckenridge, Vail, Aspen, all over. If there's, Tahoe I'm going to this year again. And I'm happy wherever there's snow and good friends.
Well, also 3 boys, 19, 17, 14, that I'm guessing that they're probably snowboarders too then, if that is. And that's kind of cool.
No,
they're
believe
not.
it or not.
They're not.
No, it's
are they skiers
no,
or they don't?
On skis. Yeah.
Really?
We're the backwards family. My wife and I snowboard, and the boys ski. And it's kind of funny because, when I started snowboarding, I was a skier before snowboarder, and I took it up in my early 20s. And that was sort of the time that snowboarding took off. But when you think about skiing back then, it wasn't as fun. And so all the kids who wanted to get in the snowboard park and go to the half pipe, they all got on the snowboard. And then what happened was skis took a page out of the snowboard book, and they started shaping them and making them more fun. And all of a sudden, the skiers were in the park, they were in the half pipe, they were doing this. And there was really no reason for kids to transition. So I think you're actually seeing, you saw mass adoption of snowboarding in sort of the 90s and maybe going into the early 2000s, but that's fallen off quite a bit. So no, we're the bad. My wife and I stand in line.
So I'm a skier. My wife's a skier, and my kids are like, oh, they ski, but they're like, I want to learn how to snowboard, and I always thought it was the younger generation that liked to do it. But
no, and I'll tell you, Dan, what I like about it too is it's what I call active meditation. I was telling my wife about this. It's like my happy place. When I have trouble sleeping or have anxiety, I just close my eyes and I think about that, going down the mountain, endless powder below your feet and just riding, and it's like surfing, and just you're not thinking about anything at that moment in time. And I think, whether you're skiing or whether you're snowboarding, I mean, it's all great, but you need those moments where you're not looking at your phone, you're not around, and you're just thinking about the 30, 50 feet in front of you and taking in the fresh air and loving it. And everybody needs to recharge.
That's fantastic. Absolutely. Well, you've got a good one there. Hey, if somebody wants to reach out to you, what's the best way to get to know you guys more?
OriginInvestments.com. You can go right to our website. We make it super easy. You can connect with anybody in IR right there. You can also email them at investorrelations@origininvestments.com. I know it's a long one. But all of our materials are downloadable. So we really leave it up to the investor if they want to have a conversation with us. So I highly recommend go to our website. You got to fill out some forms, but you can download our deck. You can read about us. You can learn whatever you want. And then if you're interested in taking next steps, just reach out to somebody in IR, and they'll be happy to answer any questions you have.
Fantastic. Well, Michael, I appreciate you coming on the show. Listeners, I hope you enjoyed that one. These guys have a ton of experience, and I'm just glad we got a chance to hang out and talk. And I'm going to stop recording, and then I'm going to hit you up on the Opportunity Zone Fund a little bit more. So hope you guys enjoyed that one. Until next week, signing off.
Thank you for watching Darren Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darrenbatchelder.com/learn.